a lot of students will be hearing us, do not take up trading as a profession. And I'll tell you why. Phrase RBI was pseudo puppet to what the government really wanted to do, right? So the government would typically use RBI to make changes to the policy depending on what will work in favor of the government.
Hello everyone, today with us we have Mr. Kirtan Shah, who's the co-founder and CEO of FPA Edutech, and along with that he's also the founder and CEO of Credence Private Limited. Apart from that, he's also been a frequent guest on CNBC, NDTV and ET. So we were really privileged to have you with us over here today.
Thank you so much for having me over.
Alright, so to begin with, tell us something about your journey, if you could share some insights into how you started these two ventures and how did you set them up?
I think very honestly, I'm a very firm believer of luck favors the brave. I think my story is very similar to that. So while I'm talking to a set of students who are probably amongst the best college in Bombay, my educational background has not been that inspirational. So I was very good at studying while I was in the school. So back when I did my schooling, which was 99-2000, when I cleared my 10th standard, I got some 80-83%, which was very great at that point in time.
Definitely.
But unfortunately, we did not have a lot of sense at that time of studying something that is close to what you want to pursue as a career. At that time, typically what happened was, depending on your score, you would decide whether you would do science, commerce or arts. There was nothing else. So it was very clear. If you've scored more than 80, you go science. You've scored less than 80, you do commerce. You've scored less than 60, you do arts.
So how did you end up taking commerce and then went on and did financial engineering?
Yes, so that's the most interesting part. So when I got what I got as marks, of course I ended up taking science, unfortunately, for my 11th and 12th. So in the 12th standard, I was passed with grace marks. I'd actually failed, but because the college had to save their nose, they gave me grace marks and passed me in the subject called computer science. And that's when I realized that, science is something really not for me. In fact, I still made an attempt. I took my first year engineering in aeronautics.
Wow, okay.
And in the first time out of 5 subjects, I failed in 4th. So this time I was not lucky around to pass with grace. They actually failed me in 4 subjects out of 5. That's when I realized that, probably science is something that probably does not suit what I intend to pursue as a career, is where I made a switch to commerce. And I think that is exactly when I think things changed for me. I realized that I was slightly behind all my peers in the school and 11th and 12th who probably took the right step in the education, and I was a step behind of because I failed my first year of engineering. And that's why I decided to do some other programs along with my graduation, and yeah, here I am today.
I think we share a similar background then.
Really?
Yeah, I also ended up taking science in the 9th and 10th grade because I really wanted to, do something in that. But once after 2-3 months the school started and stuff, I realized that this is not where I want to go in the future. And again, I also made a switch and ended up taking commerce and now pursuing.
I'm glad you ended up doing that in 2-3 months. I took 3 years to realize that.
Yes, definitely. So now, since you are big on finance, investments, let's go back in time. Let's say you're 18 today with the knowledge that you have right now. How would you begin your investment journey?
I think that's a very interesting question. I'm assuming that my knowledge stays where I am today, and so I'm going to do 3 things. The first thing that I am really going to do is have a mediclaim for myself. I keep telling this to everybody that I meet. People are misguided by the internet, where they say start early and start investing as soon as you start making money. I think that's a very wrong.
Yeah, in this world of instant gratification.
Yes, that's a
people are
very
just
wrong.
behind,
Absolutely, that's a
gaining
very
quick
wrong
money.
interpretation of financial planning. And I'll give you a logic why do I make that statement. Imagine you start doing a 5,000 rupee SIP for the next 3 years.
Yes.
Okay, because on the internet you are told start investing as soon as you start making money.
Yeah.
And probably at the end of the third year you've accumulated 2.5 lakh rupees, assuming 12-15% return that you would have got. Now imagine, unfortunately for whatever reason, you have to get hospitalized.
Yes.
Now if you've got to get hospitalized, you would not even know today how much does hospitalization really cost. Right? So if you are going to get hospitalized, your bill is going to be 5 lakhs, 6 lakhs, 10 lakhs, depending on whatever you've got hospitalized for. And I'm sorry I'm saying this, but this is just for an example. You will understand that everything that you accumulated over the last 3 years is falling short of what your actual requirement is for hospitalization. So in that context, you've actually got bankrupt.
So it's
Right.
better to be prepared for the worst.
100%. So as a young investor, as soon as you start making money, the first thing that you have to provision yourself for is hospitalization and hence a mediclaim.
Right.
Get yourself a mediclaim, because you starting to early invest will not help you save enough money if there is a hospitalization. Do that first. The second thing you really want to do is get yourself a term insurance. The logic is the same. Let's say even if you've saved for 10 years, as soon as you start earning, you would still end up accumulating 10 lakhs, 15 lakh rupees, right? Which is not going to be enough if something happens to your life, right? Which your sum assured will be able to do to the nominee that you actually want the money to be received, right? So let's say if something happens to you, and I'm sorry again I'm saying this, something happens to you 10 years after you start working, you will never be able to accumulate a crore.
Right.
But probably with a 5,000, 6,000 annual premium, you will be able to get a sum assured of a crore at the age that we are talking about,
Yes.
which is a very large sum for the nominee, which you will never be able to accumulate. So my real advice to anybody who's starting afresh in terms of investments, and if I am 18 and I have this knowledge and I want to start, I'll first take a mediclaim, I'll then take a term insurance, and then I will start my SIP. These are the three things that I really want anybody who's 18 years to understand. Starting early is not as important as doing your risk management first.
So a lot of us, since we're just entering into the world of finance, we're not very sure of what SIPs are. So could you please explain to our viewers, if you had to explain in 2 lines, what an SIP is and how it is going to benefit you in the long term?
So I think there are 3 things that I really want to tell you. First thing is, SIP is a brilliant way to invest in the equities market. Now somebody who's 18 is not going to have a very large amount of money to invest at one time. What SIP does is gives you an opportunity to invest 500 rupees every month or every week.
Which is pretty doable for college students.
Pretty doable, right? You end up skipping a meal with your friends, or probably a hookah with your friends. You will be able to accumulate that amount of money to do an SIP. So what it actually does is 500 rupees every month. That gives you a cushion which is doable. One. Second, you don't end up timing the market, right? So what SIP does is helps you with rupee cost averaging. You do 500 every month for the next 12 months. You've invested 6,000 rupee and you've been able to do it across the next 1 year, and hence you've not timed the market, you've averaged it over the next 12 months. Third, and the most important thing that you need to understand is, this over a long term helps you compound your money in ways that you have no idea about. You continue to do, so I keep telling, and there is this very interesting math. If you continue to save 30% of your income every month, in 15 years, you will be able to be financially independent.
Okay.
So let's say if I make a lakh of rupee a month,
Yes.
and I save 30,000 rupees a month, in 180 months, which is 15 years, I'll be financially independent,
Wow,
right?
that's amazing.
That's the power of
Compounding.
compounding.
Absolutely agree. Speaking of that, what are the 3 financial or investment books that you would recommend to freshers like me who want to begin their investment journey or anything in the world of finance?
I think that's a very interesting question, and I'm going to give you the books that I've read myself, right? And they may not be directly finance, in the sense it's not going to help you understand P&L, cash flow and fundamentals better. But I think these are the 3 must-read books, in my opinion, for you to understand why becoming a long-term investor will make a lot of difference in your life, or why starting early will make a lot of difference, why staying invested will make a lot of difference. I think the first book that you should read is Rich Dad, Poor Dad.
Yes.
Extremely important book for you to read. Another book that you should read is The Monk Who Sold the Ferrari.
Yes.
And the third book, which is slightly more technical, is One Up the Wall Street. I think these are the 3 books, in my opinion, somebody who's 18 should definitely start reading on.
You mentioned about why one should stay invested or a long-term investor. So what is your take on intraday trading or the day trading that currently teenagers and the young investors are pushed towards?
I'm glad you asked me this question, because I am so keen to share my understanding on this subject with a lot of students who will be hearing us. Do not take up trading as a profession, and I'll tell you why. Look, a lot of people feel trading is very quick money, right? But I can tell you, as a trader, your mindset and your homework needs to be far more than most other jobs that you really want to apply for.
Right.
Unfortunately, a lot of people end up taking trading as a business or trading as a full-time thing because they think this is quick money.
Right.
The problem is that along with that quick money, people are not prepared to kind of put in the homework or the time that you really need to become a good trader. And which is why even if you go back to what SEBI has been able to do in terms of data crunching for the last 3 years, even SEBI comes out and tells you that 90% of the traders lose money in the stock market. Now, the reason why 90% of the traders lose money in the stock market is because they are not ready to put in the homework that really needs to be done, because they think that trading will make them quick money without realizing that it requires far more research and effort for you to put in for you to make that quick money that you are thinking of. So if you are not willing to put in the time that really is required to clear a CFA exam, or not able to put in the time that really requires for you to crack an IIT, IIM, you will not be able to be a successful trader, because it actually requires that amount of time for you to become a successful trader. Otherwise, everybody would have made monies, right?
Exactly.
So don't look at trading as a bet that will play off in your favor if you're not willing to put in the time. If you're not willing to put in the time, you will be amongst the 90% of the traders who actually lose money, and not the 10% who actually make money.
Absolutely agreed on that, I feel. So currently a lot of geopolitics and everything is in place. What are the sectors that you feel are bullish? What are the sectors you're currently bullish on and that you feel that they will boom in the future in the next 5 to 10 years?
So I don't know when is this podcast going to get played, but if I have to name 2 sectors, in my opinion, that we are extremely bullish on at this point in time that I talked to you of, first is banking and second is chemicals. Okay. And I'll give you a logic to why. You look at banks at this point in time, unfortunately, a lot of these banks that I'm speaking to you of are trading at probably 2020 Corona valuations, right? You look at something like an HDFC, you look at Axis, you look at IndusInd, and I think there is a lot of tailwind in terms of opportunity that is supporting the private banks at this point in time. So we are very bullish on private bank, and we are getting all our clients to kind of build positions on the private banking side of investing. And second is slightly more contra to what the market believes. We love chemicals at this point in time. We feel that probably over the next 1 or 2 quarters, the results are going to start stabilizing. There is a huge value proposition in chemicals at this point in time. And again, with Trump winning, what is going to happen to China is going to be a big positive, in my opinion, to the chemical and the pharma space. Pharma is slightly technical, so is chemical, but I think if I have to name two, I would say private banks and chemicals.
Speaking with respect to banks, I think the US Fed they recently started cutting the rates. Where do you see that happening in India? Do you think it's going to happen anytime soon, or the rates stabilizing anytime soon?
I love when, as a student, you ask me very relevant questions, and I'm so glad that I'm doing this podcast. Look, what you have to understand is, you go back 10 years from today, and you would see that RBI, and I'm sorry I'm using this phrase, RBI was pseudo puppet to what the government really wanted to do, right? So the government would typically use RBI to make changes to the policy depending on what will work in favor of the government, right? RBI was very globally influenced. They would act basis what the global large central banks will do. Cut 10 years forward today, I think RBI is so independent, right? It has cut off itself from the government to almost 100%, and it has no influence to what the global policy makers have to do. It is extremely domestic focused. And I'll tell you why do I make that statement. In my 15 years of investing journey and whatever I've learned before 15 years of starting to invest, I can tell you I've never seen an instance where US, the largest economy, cuts rate twice, 50 bips and 25 bips, and India does not move. This is the first time in my reading history of markets that US has cut rates twice, US has reduced rates by 75 bips, and India has not done anything, right? Because please understand, when US cuts rate, it is not just the interest rate, but it's a huge currency movement that India faces. You see over the last 2 months that US has cut rate, India currency is depreciated to all-time low, and yet you've not seen RBI cut rates, and I don't think RBI will cut rate even in December. Our guess is that RBI will cut rate in the first quarter of the next calendar year, because by then we are hoping that inflation will stabilize. RBI is very, very, very clear that unless inflation domestically in India does not stabilize, they will not go ahead and cut rates. If you see the last policy statement that came out, it was above the RBI comfort level, and we don't see RBI cutting rate this quarter. So our best case is that probably first quarter of the next calendar year, RBI should go ahead and cut rates. Probably if crude sticks around the way it is, and we believe because Trump has come to power, geopolitical risk will slightly stabilize on the war front, which will probably support crude, hopefully a little, and that should give some room for RBI to go ahead and cut rates over the next first quarter in the next calendar year.
All right. Speaking of Trump coming to power, do you think Indian investors should go and explore the overseas market and consider the overseas market as an alternative option for their investment?
100%. Look, if I have to tell you, and I have a lot of people who come back and ask me this question as to what gives me confidence that Sensex will end up generating the kind of returns that Sensex has generated over the last 45 years. And I tell them that please go back and check what Dow has done over the last 100 years. Today also, if I have to talk to you about a 3-year or a 5-year CAGR on Dow, it has done better than what India has been able to do in rupee terms. A lot of investors will not know, but US over the last 3 years and 5 years has done better than all emerging markets, including India. So with Trump coming in, Trump is expected to be a very, very, very strong proponent of helping domestic domestic market and domestic companies. So I am assuming that with Trump coming to power, China is going to have a big problem, which is going to give a lot of boost to India, because China plus one as a theory will again start playing out. But at the same time, it's going to be a huge boost to domestic companies in the US. So if there are people who are looking at globally diversifying the portfolio, I think there are two countries that you should really look at. One is India for NRIs who are looking at options,
Yes.
and one is US for Indians who are looking at diversifying globally. Because if you look at any other space outside of this, there is hardly any emerging market or a developing market country who's been able to come close to any kind of returns that India or the US has generated. Yes, there is one country. If you look at Taiwan, Taiwan's been able to do really well, but with Trump coming to power and Taiwan and China relationship, I think Taiwan may not end up giving the same kind of returns that it has generated in the past. So India and US are the two countries that you should really look at.
All right. Now, since we're discussing a lot about US, India, China, recently there was a BRICS summit where they were, against de-dollarization. They were in for de-dollarization and, bringing a new currency. So how do you think that is going to help India in the future? Having a new currency altogether, not a new currency altogether, but like something against the dollar. Will this give Indian rupee a chance for revival?
Look, I'll tell you, my view is that de-dollarization is not going to be of an immense impact in your and my lifetime. It's going to take decades for de-dollarization to really see the day of light. And I'll tell you why. 83% of the world trade today happens in dollars. Right? Which is why when you go by basic macroeconomics, ideally what should happen is when the debt of the country goes up, or when the country prints more and more currency, which the US has been doing for decades together, their currency should actually fall, right? Today, US, if I'm not wrong, is sitting at a $25 trillion debt. It has printed money equal to India's GDP every year over the last one decade that I know of, right? But you've seen that dollar has only become stronger against all the other currency, right? So it defies the normal logic of macroeconomics that your currency should typically fall when you are printing more or you have more debt. The only reason this is happening is because you have them garnering 83% of the global trade. I'm not sure, and because these are 18 years old or 20 years old who are going to hear us, I'm going to tell you a very interesting story. I don't know if you all know why does US typically get involved in global wars. Suppose if I have to ask you, why did US fight a war with Saddam Hussein, right? And a lot of people will say that they fought war with Saddam Hussein because of whatever media spoke of, or somebody who is slightly more aware than the media will say because they wanted the oil wells, right? Now, let me ask you a question. If they fought the war with Saddam Hussein, or if you see any of such instance that keeps happening, right? If it was for oil, right? Why did they then form a local government and move their army out? Why did they not take control of the country if they actually wanted the oil, right? It's actually not oil, but it is oil, and I'll explain to you why do I make that confusing statement. Yes. Please understand, the biggest trade globally that happens is oil. Okay? And the war on Saddam Hussein happened because Saddam Hussein was the first person who came out and said that I am willing to trade for oil in your local currency. Okay. Right? Now what that does, let's say if the Middle East starts trading for oil in the local currency, that reduces the dollar domination in the world. Because today when I tell you 83% of the world trade happens in dollar, right? Most of that is in oil. And if the oil producing countries start dealing with trade of oil in the local currency, the dollar domination reduces. Which is why you see whenever there is an oil related war happening, US will always want to interfere because they want to dominate the oil denomination and trading in dollar globally, right? So coming back to what I was telling you, 83% of the world trade happens in dollar. And till the time this does not go down, which is not going to happen anytime soon, de-dollarization is only a distant hope, right? Today you look at central banks, except for China and Russia, right? There is hardly any central bank who has treasury reserves in any currency outside of the US dollar, right? So you forget about everybody else, look at India. Look at India, right? I can tell you 95% of our currency reserves outside of the Indian denominated rupee is all in the US, right? So if as a central bank, not just you but everywhere else, if that's the whole lopsided denomination of dollars that you hold, how are you going to be able to de-dollarize? Of course you want to de-dollarize because there is a big problem. The problem is, look what happened to Russia, right? Russia ended up doing a war, right? US didn't want that war to happen. So what did US do? US said that, all the $600 billion worth of US treasury that you hold Russia, I'm not going to pay you back. Sanction. Which means Russia invested in the US treasuries, right, or US bonds, and US said, do whatever you want, I won't pay you this money back, sanction on you because you are not ending the war. Which means everybody is now scared that you have your reserves in US dollars. Now suddenly if you don't go the way the US wants you to go, they will put sanctions on you, they will say, I will not pay you your money back. Then what do you do? Right? Which is why if you note over the last 24 months, China has been buying gold every month. Why? De-dollarization. Because they want to reduce their reserve dependency on US dollar and move that to gold. Right? So the world is trying to de-dollarize, specifically elements like Russia, China, who have a lot of fight or who need to get scared with US because of the way that they operate. They are definitely de-dollarizing at a very, very, very fast rate. A lot of Middle East countries now deal with India in the local currency, even in the oil trade. So the world is trying to do this, but please understand this trade in dollar is so deep rooted, it's going to take decades for it to really end up making an impact. I hope that helps your audience.
Yes, definitely. How do you think do government policies they affect the stock market, since we have a lot of young investors who are keen on knowing this?
Oh, I think the government policies make a lot of impact. And I am somebody who very strongly believes that you try and stay away from any sector which has direct government policy impact, because if you don't have a stable government at the center who's very focused on making sure that India domestic industry is growing, will always end up creating a problem for you in the longer run. Because look, there is any policy change that the government makes at the center, you are the one who is going to end up paying the brunt for it. I'll give you an example. Do you know what Starlink does? So Starlink is Elon Musk's company, right? Which is largely into internet using satellite.
Yes.
Today, how are you getting internet? Today, you are getting internet because of your tower connections,
yes,
right? Or fiber connections which are laid out.
Yes.
Now, let's say, of course, you do a lot of satellite also, but because I'm talking to people who are not very well versed with how the industry operates, and I'm trying to keep it simple. So now what is happening is that all your current telecom players in the country are all operating either through fiber or either through tower to give you satellite, right? Of course, Jio does to give you internet. Jio does a little bit of satellite, so does Airtel through partnerships. But let's say, as a layman, internet comes to you either through the fiber or the telecom towers. Now suddenly, Elon Musk comes and tells the Indian government that I will be able to give you I will be able to give internet connectivity through satellite. Now let's say if none of our players have satellite related internet connectivity opportunity made available, right? And the government says that I will not do bidding like it normally does, but I will give it at a fixed price. Then how do people like a Jio or an Airtel or a Vodafone will end up competing to somebody like a Starlink? That will disrupt the entire telecom space in India. And that's exactly what is happening. The telecom ministry in India is saying that we will not do the bidding process like we generally do to sell waves. It's called waves, right? But we will allow satellite internet connectivity at a fixed price. And that will make it very difficult for people like Jio and Airtel specifically to be able to compete if Starlink is given a fixed price here. So what typically happens is when you invest in sectors where there is a lot of government policy involvement, even if you invest at the best of the P&L cash flow balance sheet of the company, you don't know how a policy change will end up impacting your business.
Right. With respect to that, I think a lot of us, we put our investments, maybe if we're influenced through some financial advisor, investment advisors, but at times we are unable to decide when to exit that investment. So what would your advice be on that?
See, I'm going to give you two answers to that question. Let's say if you are a retail investor who does not really understand investments so well, you only exit your investment when you need the money for your goal, right? So the first thing I keep telling my investors is when you are investing, link it to a goal. That goal can be your own retirement, that goal can be your child's education, child's marriage, you wanting to buy a house, you wanted to go for a world trip, you want to buy a car. There is a goal for which you are investing.
Goal-based investment.
Yes. So you only redeem this investment when you are close to your goal, because you invested for the goal is approaching, you need the money, remove it, right? That eliminates your timing impact, right? Because I'm not sure 9 out of 10 investors that I end up meeting, they know how to time the market.
Yes.
So link it to a goal. But if you are a sophisticated investor who understands markets a little, right, and you understand that the markets are getting expensive in terms of long-term valuation averages, then you might want to trim down your equity allocation till the time either there is a time correction or there is a price correction and the market valuations have come back. So like say for example, at the end of September, we trimmed down our clients' position in equity because we thought markets were very expensive. And now in the third week of November that you and I are discussing, we've started allocating money back to equities. So the point that I'm trying to say is, if you're a retail investor, you don't sell till the time you have a goal. If you are a sophisticated investor who understands market, then you try and time when it becomes extremely expensive and you think that this does not justify the valuations in the market.
All right. Now, speaking of allocations and all, how important do you think is asset allocation when you are investing, and how does it help you diversify your portfolio?
I think asset allocation is the holy grail of investing, and I can tell you, irrespective of how sophisticated as an investor you think you are, you really want to make sure that you have an asset allocation in place. I'll give you an example. Let's say I'm a very aggressive investor, and as an aggressive investor, I am okay with seeing my portfolio go down 50%. Okay? even if that's my aggression in terms of investing, right? Imagine if I am in 2020 Feb and I have allocated all my money to equity and Corona happens and my portfolio falls down 40%, right? Let's say I'm good with it because I'm an aggressive investor. I understand my portfolio can go down by 40%. That's not a big deal. But I also understand that if the markets have fallen 40%, I should invest more money. 9 out of 10 times, most people who are aggressive investors would always be allocated 100% to the markets. Where are you going to get more money to invest for? That's also when asset allocation comes into picture. So as an aggressive investor, if I have had 80% in equity and 20% in fixed income, right? Not only that, it would have balanced my portfolio, but I would have also had that 20% additional money from fixed income that I could have removed to buy the markets lower. Because you talk to anybody who's investing in the markets, every time the market falls, they will never have more money to invest.
Right.
Because they are always invested. Right? This is one very crude example of why even the most aggressive investors need asset allocation. Right? And there is a lot of study already done by very large market participants. I think if I can quote Morningstar, who's done this study multiple times, which says 80% of the returns that you generate are because you are rightly allocated. So I cannot emphasize enough on why asset allocation, depending on what your risk profile, is the best way to do investing.
I think now before we end the podcast, we'll have a quick rapid fire.
Please, happy to do that.
Yes. So I'm going to list a couple of assets and you can just tell me invest or not invest in them. We'll begin with stocks.
Invest.
Real estate.
Avoid.
And why do you say so?
I think I am somebody who believes that in real estate, you should have a house that you stay in, but don't keep real estate as an investment for 3 reasons. First, it's extremely illiquid. Second, the rent yield that you get is not more than 2-3%, which means if you have a 1 crore house, the average rent that you will make is 20,000 a month, which is 2,40,000 a year, right? And also, because traditionally real estate has been valued as a multiple. So if you go back and talk to our parents, they will say that I bought this property for 20 lakhs, which is now 1 crore. So this has become 5 times. Nobody calculates real estate returns in terms of XIRR. Right. And hence they don't understand that enough and more reports are made how the real estate is not making you more than 6-8%. So if I'm going to make 6-8% plus I'm going to get 2-3% rent yield, right, which is 10 odd percent, and it's going to be extremely illiquid, plus the ticket size is so big, right? Yes. Why do I want to invest in such an asset class, right? I can make much more returns, I can make much more dividends, I can have my money extremely liquid. I would rather do equities. And I can tell you one thing, real estate does not go down is a myth. Just because real estate is not listed on the exchange and you don't see the price go up and down, you don't realize, but there are 10-year periods where real estate has done absolutely nothing. You look at
stagnant after
that. You look at 2010 to 2020, real estate returns were negative, right? You look at 1990 to 2000, real estate returns were negative, right? So I think it's a myth that real estate is a great investment.
Right. Gold?
A tactical bet. You might not want to stay invested in it for a very, very, very long period of time like you do in equity. But if you are able to time gold investing well, it can make you good money.
Okay. One personal finance mistake that you'll never repeat?
Never trade and never do FNO.
Okay.
I've lost a lot of money. I will never suggest any of you all to do any FNO trades.
Debt, good, bad, or avoid entirely?
Debt is very good if you know how to use it. Like say for example, let's talk about real estate, right?
Yes.
You only do 20% as down payment and then you do 80% as loan, right? Now imagine if you get a deal in real estate where you can exit in 2-3 years, you can do a huge leverage. Imagine a 1 crore property, you've paid only 20 lakhs and taken 80 lakhs as loan, right? In 2 years, you've paid, let's say 10-15 lakhs of that loan back, which means you've invested 30-35 lakhs. But if you are able to exit that property, right, at let's say 20% profit also, you are making 20% profit on 1 crore.
1 crore.
Which is 20 lakhs, but you've invested only 30-35 lakhs,
Right.
which means you've made a 60% profit on your investment. So if you know how to use debt, it's brilliant, but for most, it's an avoid.
Okay. With that, we come to the end of the podcast, and it was a great session, and thank you for sharing your wisdom with us, and I hope our viewers will go back with a lot more financial knowledge than they already had.
I'm just hoping that it adds a lot of value to your viewer. Thank you so much for having me.